friends. In the subject of fundamental of investment, we are talking of technical analysis. In my previous lecture on technical analysis, I talked about what is technical analysis, what are the tenets of, what are the assumptions of technical analysis, on what basis the technical analysis is being made, means how do we analyze on the basis of technical analysis, and what is the difference between fundamental and technical analysis. So these aspects we discussed and I told you in my previous lecture. In this lecture, I am starting with the Dow theory of technical analysis. Charles Dow is being considered as the grandfather of technical analysis. He was the first one to give a proper theory of technical analysis. He propounded a Dow theory which is based on the assumption that stock market does not move on random basis and rather there are set trends which can detect the direction and market movement. As I said in my previous lecture that basically it is the trends, the charts, the patterns, the graphs which we study in the technical analysis, and by studying the past price behavior of a share or of an index, means if I am talking of the stock market as a whole, of a particular stock market, right? So by studying these past price behavior, we analyze that whether the price will go up or whether the price will come down, right? And whether to buy, whether to sell. And what to buy, what to sell is being determined by fundamental analysis, and technical analysis tells you when to buy, when to sell. So it is the trends which tells you whether to buy or whether to sell. If there is an upward trend, long-term trend is upward, we say one should buy. If the long-term trend is in the reverse direction, it is downward sloping, we say the sell is worth selling, or means the investor should sell the share. So in the Dow theory, basically there are three trends which Dow talks about. The first is called primary trend. Primary trend are basically the long-term trends. It is the long-term trend over a period lasting for more than a year. Friends, there is no hard and fast rule on the basis of which I can say which is the long term, which is the short term. But I would say here, for a fairly long period of time, like say for example, more than a year, if the stock prices is rising of a particular share for a fairly long period of time, we say it is an upward trend. So it sets the direction, which means if the trend is upward, the bull market is in operation, otherwise bearish market. I'll be coming to the bull market and the bear market. Means it is a trend which reflects that the prices of share is going in one direction, that is upward. Over a long period of time, there is an upward trend, that is called primary trend, or there may be a downward trend. Trend means the long-term trend, long-term pattern you can say. Trend means direction. So it is a long-term primary, that is called primary trend. The other is called intermediate trend. Within the primary trend, there may be an intermediate trend. Intermediate trend means the short period trend. It lasts for a few months, few weeks, right? So it is in the opposite direction of the primary trend. If it is if stock market or the share price never go in one direction, never, right? For a fairly long period of time, it will go upward, but there will be intermediate stage where the price will fall also. And then again it may start rising if there is a upward trend, primary trend is upward. So intermediate trend does not last for for a very long period of time. It lasts for a few months or a few weeks. So it is in the opposite direction of the primary market, which is known as the secondary correction in the market, right? So this is called intermediate trend. I'll be showing you through a graph, right? And the third one is called tertiary or minor trend. They are day-to-day, intraday fluctuations in the stock prices which do not last for very long period of time. These are called minor trends, right? This I'll show you with the help of a graph. Now you can see here that this on the x-axis we are showing time, on the y-axis we are showing price. as you go along the x-axis, means the time, what you are seeing is, if say for example share price is 10 rupees, from 10 it reaches to say 20 rupees, right? And then from the 20 rupees it falls to 15 or 14 rupees. It is just an imaginary figure I am talking of. Then from 14 rupees again it starts rising, means if I am talking of a daily, monthly basis or a yearly basis, then again after 15 days, 20 days, it starts again rising from 15 rupees to 23, 24 rupees. Then from 24 rupees again it starts falling, right? And it falls, which is a secondary trend, right? It falls to say 18, 19 rupees. Again it starts rising, and so on, so forth. So what you are finding is that over a period of time, there is a, if I take the 1 year as a time period, what you are noticing is that the trend is upwards. The price is rising, it's falling little bit, again rising, but rising fast, larger than the previous high. Again it falls little bit, right? But when it falls, it does not break the previous low points, right? So again it starts rising, and so on. What you are saying is, and if you draw a line, that is, the line is being drawn in such a manner that it is the average of the intermediate trend, and it is going, this line is going straight in the upward direction. So this is called the primary trend. I will say, by seeing this share price, seeing the price behavior of this company share price, I will say in the long run the primary trend of this share is upward. What you are noticing is that within the primary trend, the stock prices are rising not in a linear fashion. They are rising for say for example 10 days. Again for 1 or 2 days it starts falling. Then again after 2 days it starts rising for 10, 15 days, rises and it breaches the previous high, right? Again it starts falling a little bit. When it falls, this fall is called the secondary trend. I have showed you with the line that it is called the secondary trend. And within the secondary trend, when you are seeing the line of the secondary trend, I mean, there is a fluctuation in the share price, which is on a day-to-day basis. These fluctuations are called intermediate trend. Means within the secondary trend, suppose share price goes up 10 rupees, then goes 11, then again becomes 10.50, then again goes 12 rupees, again becomes 11.50, like that. So this is called intermediate trend. So there are 3 trends which you can observe, right? One is called the primary trend, which is a long-term trend. Secondary trend, within the primary trend, within the long-term trend, there is an intermediate trend. When the price goes opposite direction, it is rising, then falling. So it is in the opposite direction, which is for a shorter period of time and for a less price, right? And then again it's rising. So this is called secondary trend. And within the secondary trend, the day-to-day fluctuation that takes place, that is called the tertiary trend. So these are the 3 trends which Dow talks about. On the basis of these trends, we determine whether the market is a bull market or whether the market is a bear market. If you see this chart and you find that the primary trend is upward, I would say the share price is in the bull market, right? There is a bull market. Or if I talk of the whole of the market, the index as a whole, I would say when the index increases, when the primary trend of the index is in the upward direction, we say it's a bull market. Like is this graph which I have shown here, it is of bull market because the primary trend is rising. When the primary trend is rising, we say it's a bull market. And if the primary trend is downward direction, the slope is downward sloping, I will say it's a bear market. I will come to it later on. Right. So what is the bull market? Bull market is a market where market is going up. When I am saying market means the index of the market. If I talk of the BSE, which is being denoted by Sensex. So over a period of time, if the Sensex is rising, the primary trend of the Sensex is rising. Stock market from 14,000 to 15,000, 15,000, 16,000, 17,000. It goes up to say 21,000, 25,000, 50,000, 40,000, 50,000 over a period of time, in a period of 10 years. So I will say it's a bull market, right? So if I talk of the Nifty, that is the index of the NSE, right? So whatever the index of the Nifty is, that 16,000, 15,000, 17,000, 18,000, right? So it is going upward. So if it is going upward, we say it's a bull market, 15 to 16, 16, 17, 18, right? So it's called a bull market. So bull market is a market where market is going up. Market means, when I say market means the Sensex, the index. Sign of optimism. In the bull market scenario, there is a all-round optimism. When I say all-round optimism means the investors who invest in the stock market, they are of view that the prices will go up further, and with the opinion, with the feeling that the price will go up further, there is a optimism and they keep on buying the shares, right? So there is a sign of optimism. Involves buying of stock in large volumes. Not only they buy, but they buy in large volumes. The investors as a whole, investor community as a whole, they buy in large volumes in the bull market. It generally takes place when the economy is strengthening or when it is already strong. See, when the GDP is going up, per capita income is going up, people disposable income goes up, I mean the tax rate is in the country is low, monetary policy, fiscal policies are suitable for the industry. So in this type of scenario, it is very good scenario for the stock market because the economy booms. When the economy booms, normally the stock market also booms at the time. So there is a all-round optimism, and when the economy is strong, the bull market takes place, right? So a rise in GDP of a country, this I have already covered, and low unemployment. So rise in GDP, low unemployment, investors' confidence will tend to climb throughout a bull market period. So when the bull market takes place, there is a lot of optimism, and the investors' confidence level means the market will go up further. There is a lot of investors' confidence. Then only, because if you do not have the confidence, you will not buy the shares, right? When you will have the confidence that the economy is booming, the industry is doing well, companies are doing well, then only you tend to buy. The overall demand for stocks will be positive along with the overall tone of the market. So means it is all in the technical analysis, we say demand and supply. So when there is a demand is more than the supply, the prices will go up. So in a boom market, in a bull market, the prices goes up. So there is a positive demand, there is a higher demand of the stocks in the market. There will be general increase in the amount of initial public offering activity during the bull market. When the bull market, it is also a sign of the bull market that lot of IPOs, IPOs means when the companies first time offer its shares to the general public, because they know it. There is optimism in the market is booming, people are very optimistic, people are, investing in the stock market, people are converting their other asset into stock market because they feel that the rise in the stock market, when time and again I am talking of the stock market, when I say stock market means the prices of the shares. When we say stock market means the prices of shares, overall companies that are dealt in the stock market, the general behavior of the share prices, that it is a rising trend. So a lot of companies comes out with IPOs, initial public offer, because they know, because of the optimism in the market, people will subscribe the shares that is offered by the companies, right? So there is a lot of IPOs that comes in the booming market. In a bull market, investors are more willing to take part in the stock market to make profit. So people feel that price will go up. So with this assumption, with this perception in the market, people tends to buy more and more shares that they will make profit in the future. So this was about bull market. The reverse is the case in the bear market. As I have been saying, that bull market is a market where the prices are going up, the share prices are going up, the index of the stock exchanges are going up. Bear market is just the reverse. The primary trend in the bear market is downward sloping. Unlike in the bull market, here you can see that in the bull market, the primary trend was upward. In the bear market, the primary trend is downward. So as the time progresses, as you move towards the right side of the x-axis, which is showing time, and on the y-axis we are showing price. In the period first, the prices are at the top, right? And as the time progresses, as you move along the time, the prices are falling. right? Prices are falling. Then in the intermediate trend, prices rises a little bit, but again fall, and fall is larger than the previous low, right? So the low breaches the previous low, then again it rises a little bit, then again it starts falling. So the long term trend is downward, the primary trend is downward. There may be an intermittent correction, there may be increase in the price, but long term the primary trend is downward. When the primary trend is downward, it is a sign of bear market. So bear market, when the market is down, shrouded in pessimism. Unlike in the more bull market where there is a lot of optimism, people invest more and more. Pessimism means people feel that the price will fall further, right? So with the perception the price will fall further, people don't invest at such a time. And when people don't invest, there are large number of suppliers as compared to buyers, means supply overpowered the demand, and that's why the prices fall further. Marks the selling of stock in large number, right? So the quantity also increase because people feel that tomorrow the price will fall further, it's better to sell today, right? So if you have 200 shares, you will think better to sell all the 200 shares today instead of waiting for the 100 today, 100 after some time. You feel that the prices are falling, so it's better to sell today. So right, so there is a large quantity that is being sold in the bear market. Generally takes place when the economy is weakening. Unlike in the bull market takes place when economy is strengthening, means GDP is rising, per capita is rising, companies are making higher profits, right? So, and such a scenario we call it positive scenario for the economy point of view. The economy strengthens, right? Bull market, but opposite, when the economy is weakening, right? The government follows tight monetary policy, there is a large fiscal deficit, policy context also, right? Government is increasing the tax rate because they need money for expenditure, and so on and so forth. In such a scenario, the weakening bear market takes place. So fall in GDP, unemployment level increases, investor confidence is low, right? So this is the scenario of the bear market. The overall demand for stocks will be negative. Number of IPOs in the optimistic market, means in the bull market, number of IPOs increases. More and more companies come out with IPOs because people's confidence level is high. In the bear market, reverse is the case, that people don't invest, people don't want to invest in the market, and they're of the fear that if they invest in the IPO, the price may not be once the prices, the company share price get listed in the market, right? It may be less than the price at which it was being issued by the company. So with this fear, people do not subscribe such companies, right, in the time of the bear market. So in a bear market, investors are more willing to get out of their holdings in the stock market in order to minimize their losses, right? So this trend I have already signaled, the primary trend is downward. So this is about your bull market and the bear market. So in the bull market, the primary trend is upward. In the bear market, the primary trend is downward. Means in the bull market, over a period of time, the stock prices rises. In the bear market, over a period of time, the stock prices falls. This is about your bull market and the bear market. Now, after talking of the bull market and the bear market, see why we discuss this bull market and the bear market, because by studying the trends, you can make out that whether the market is in the bull market stage or whether the market is in the bear market phase. In the bear market phase, the tendency of the technical analyst, means what the technical analyst will suggest you is to sell. How you determine where is the bear market or the bull market? By seeing the trends. This is what we do in the technical analysis. So what is the trend of the share price? What is the trend of the stock market? That will determine whether the market is a bull market or the bear market, right? So that will determine when to buy, when to sell. Now, after talking of bull market and the bear market, now I'll be talking of certain stock indicators. Means we are talking of technical analysis. In the technical analysis, there are certain indicators which helps us in determining, in deciding, in indicating that whether to buy the share or whether to sell the share. Means is it the right time to buy or is it the right time to sell? One of the indicator is called support and resistance level. See, support price is the price at which the stock of a company, the share price of a company gets support. Means there is a likelihood that the price will not fall further. That is called support price. And resistance level is the level where the price goes up to that level and does not increases beyond that. Supposing I talk of a company X, the share price of company X increases from 500 rupees to 600 rupees, or say for example 700 rupees. Then again it starts falling. 700 becomes the resistance point. Again it starts, means it comes to up, say for example 650, 640. Again it starts rising, goes up to 700. But the moment it reaches 700, it starts falling again, right? So this 700 level become resistance. Time and again, 2, 3, 4, 5, 6 different cycles, it goes up to 700, but the moment it reaches 700, when I'm saying 700 means around 700, it starts falling. So that level is called resistance level. When it starts falling, sometimes it falls from 700 to 640, 650, 660, right? And it comes up to the 600 level. In many cycles, when it reaches 600, again it starts rising. So this 600 becomes the support level. From 600 it goes to 700, 700 it falls some level, but in the long run it falls up to say 600. The moment it reaches 600, again the buying emerges in the stock and share price starts rising. So this 600 becomes the support price. If it happens many times, it becomes the support price of a share. Support price means normally below which the share doesn't go in a particular span of time which we are talking of. And resistance level is the level, beyond which share doesn't go up in a span of time. So that is called support and resistance level. So support and resistance level can be identified both for market index and individual stocks. Support level is that price below which the price is not expected to fall. Resistance level is that level above which the price is not expected to go, right? So what is the relevance of this support level and resistance level? What it means is that if the share price reaches the support price, it's an indicator that it is a time to buy the share. And when the share reaches a resistance level, it is an indicator, means the technical analyst, technicians studies the chart, the price behavior, and the moment it reaches resistance level, especially the traders, because as I said, technical analysis is more being used by the short-term traders or the traders, or means the short-term investors, those who invest for 1 month, 2 months, right? So positional, we also call them positional traders. So when it reaches a resistance level, it is an indicator of the chartist that it is a time to sell. So if stock prices breaches the support level, it indicates a bearish run. Again friends, I'm going beyond support level now. I was saying from 700 to 600, 600 to again 700, 700 to again 600. So 600 becomes support, 700 becomes the resistance. But supposing if it reaches beyond 600, it means it is a bearish run. Now the stock price will fall further. Now the resistance has been broken, and since the resistance level of 600 has been broken, it's an indicator that the price will further fall further. Means there may be a deep correction in the share prices. So if stock price reaches the resistance level, it indicates the bullish run. Similarly, if it breaches the 700, 2-3 times it reaches 700 level, which is the resistance level, but if it goes beyond 700 for a fairly long period of time, say 3 days, 4 days, 7 days, 10 days, right? We say now it's a bullish run, means it will go further. In cases of breach in the support or resistance level, fresh levels are established. In a bull run, these levels can be revised upward, and in a bear run, these levels can be revised downward. So here you can see, right? So support is at a particular price. What you're seeing is in different cycles, these arrows in the downward, there is a line below this, right? So the downward, the line and the arrow which you are seeing, that at the bottom it is a support level, and at the top it is a at the bottom it is a resistance level, and at the top it is a support level. So in this way, what you see showing is that on the x-axis we are showing the time, on the y-axis you are showing the price. So as you are seeing here in this graph, that when the share price reaches a particular level, right, it doesn't breach that level and again starts rising. When a share price reaches upward at a particular level, it starts again falling. So that is called the support price, resistance level. Sorry, that is called resistance level, beyond which the share price is not going up. So when the share price reaches the resistance level, it is an indicator that it is the time to sell the share. When it reaches support level, it indicates it is time to buy the share. But supposing it breaches the resistance level, it means again now the price will go up further, and it is a bull. It is a signal of bull, means increase in the prices. The moment it breaches a resistance level, it means the price will go up further. And moment it breaches the support level, it means the price will come down further. So this is basically support and resistance level theory. I am not discussing that. Now the other indicator is advanced decline ratio. What this advanced decline ratio is? In this ratio, what we see is how many shares, like say for example in the BSE, 5,000 companies all on average, 3,000 companies, if I take an average of 3,000 companies are traded on a day-to-day basis, right, on a daily basis. How many number of shares, the price of the shares have increased in a particular day? When I say increase means, we compare the last closing price with the current day, means today's closing price of the shares. So if the number of share prices which have become higher than the previous close, we say the share prices advances. And the number of shares, the price of the shares which are declining, which means the closing price of the today is more than the closing price of the previous day, it means there is a share is declining. So if number of shares that have advanced from the previous day is larger than the number of shares that have declined, this ratio is called advanced decline ratio. And if number of shares advances are more than the number of shares decline, means there is a strength in the market. It shows that the strength in the market, when the market is in the boom situation, is a booming situation, or market is in the optimism, then the number of advances increases, is larger than the number of decline. So it is an indicator that there is a strength in the market, the price will increase further. So this ratio compares the number of stocks that closed higher against the number of stocks that closed lower than the previous day's closing prices. So advance minus decline is the number of stocks advancing divided by number of stocks declining. So if you divide number of stocks advancing and divide by number of stocks declining, you will know the advance decline ratio. And if this ratio is greater than 1, it indicates the positive price movement, positive trend in the market. It indicates the strength in the market. The other indicator is relative strength. Friends, these are all indicators. This all technical analysts studies these, right? They see what is the primary trend, secondary trend. We analyze the trend. We see what is the advanced decline ratio. We see what is the breadth in the market, right? And other is relative strength. Relative strength means that it compares the stock performance over a recent period to the market performance or other stocks in the same industry. If I talk of steel industry, there are 10 different companies of steel. There are 10 different companies, which deals in the steel business. I am talking of the steel industry. So the share price of one of the company is increasing greater than the share price of the other companies in the steel industry. I will say there is a relative strength in that X company, which their share prices are increasing larger than the share price of other companies. As I said, in the for example, steel industry, there are 10 companies. Say if I name it, say Tata Steel. If the share price of Tata Steel is rising greater than the prices of other steel companies like say Jindal Steel and all these steel companies, right, I'll say there is a relative strength in the company. So it compares stock performance over a recent period to the market performance or other stocks in the same industry, right? So if the company has the share price of a company has a relative strength, it's a sign that one should buy such company. It's a time to buy such stocks. So this ratio is the stock price divided by the market. This can also be calculated not only by comparing with the industry, but with the index of the market as a whole. So this ratio is the stock price divided by market index. If the ratio increases over time, it shows relative strength of the stock and profitable investment opportunity. Means those companies which are having the share price of those companies which are having its relative strength, it's a good buy from the technical point of view, right? Similarly, we can talk of volume indicator, right? Volume indicator means the stock past volume data provides useful insights into its own short-term price movement and hence can be used in predicting stock prices, and researchers have observed that if there is a rising bullish market, the volume is large, so we say it is an indicator the price will increase further. And in a market, bull market, if the volume is small, it means it's not a good sign. Similarly, in the bear market, if the volume is large, it's a sign that the price will fall further. In the bear market, if the volume traded of a particular share is less, it means not many suppliers, not many sellers are ready to sell at this price. So this is called volume indicator. In what volume the shares is being dealt in a bull market and bear market, that also indicates the future price behavior of a share. So friends, these are the few indicators which I have talked about, right? So in this technical analysis, we have talked about Dow theory, we have talked about the strength, relative strength, we have talked about various indicators of the technical analysis. I'll continue with this technical analysis in my next lecture. Thank you very much.